Hello. In this 10-minute session, we're going to look at the important topic in GCSE business of revenue, costs and profits, and hopefully by that time we'll understand it a little bit better. So let's see what you need to know. We need to understand these 5 key terms: revenue, variable costs and fixed costs, total costs, and profit or loss. Let's look at revenue first. So this is the amount of money that a business brings in from selling its goods and services. And it's really important to remember that no other source of income counts as revenue. So if a business were to sell off an asset, like a delivery vehicle, or receive money from a bank in the form of a loan, then that wouldn't count as revenue because it doesn't arise from selling the goods and services that's core to that business. We've got a really important formula here. That's our selling price for 1 unit of output multiplied by the number of units the business sells. So, if a burger van sells burgers, quality burgers, for £8 each, that's 50 burgers a day, giving us a revenue of £400 a day. That's the £8 per burger multiplied by 50 is £400 revenue a day. So for a 20-day month, we're getting £8,000 in revenue. Variable costs now. So costs will be the money leaving a business so that it can trade and operate. And in terms of variable costs, these are the costs of supplies of raw materials, bought-in goods, workers' hourly wages. These will vary directly with the number of units of output that business sells. So pretty obviously that would include, in the case of our burger van, the baps themselves, the burger patties, the sauce, the salad, any sort of cartons, napkins, ketchup. And it seems reasonable to think that might be about £2 per burger. Your total variable costs are these variable costs per unit of output, but crucially multiplied by the number of units sold. So in this case, it's unlikely that there would just be £2 per day or per month or per year, whatever. It would be £2, but only if that business were just to sell 1 burger. So if it sold 50 burgers a day, that would be £100 variable costs per day in total. That's the £2 times 50 burgers. And a month, a typical 20-day trading month, that would leave us with £2,000 total variable costs. This is really important as well. Remember that workers' hourly wages would be a variable cost of trading, because in busy patches, busy times of the week or the day, it's likely that more of these workers will be needed to serve customers and to physically operate that business in order to get these products out to customers. So yes, they are linked to sales. They're going to change directly by selling more units of output. So that's something that students often seem to overlook. That's not the only kind of cost that the business is going to face, though. The business is going to face a whole different range of costs, and these costs will not change directly with the number of units of output, with how busy that business happens to be. So bringing up 1 or 2 examples, that could be things like insurance, advertising, rent, operating license, owner's salary, and another really important point to remember in this topic here is that fixed costs are not fixed because they can't change. Of course, fixed costs can change. If the insurance company puts up your premium, then you're going to pay more in insurance. But that's not because you sold more burgers. It just happened to change for another reason. So the owner took more salary out of the business, then that fixed cost would change. But maybe not because the business got busier. So let's look at some examples of fixed costs. In this case, per day, it may cost us an average of £10 to rent the burger van. The manager, Dave, let's say, he's not being greedy. He's taking £100 salary out of the business a day. It might cost £5 to insure the van, and the council could charge £5 on average a day to trade in that local area. giving it a total of £120 in fixed costs per day, which when we multiply that out by a 20-day typical trading month, that could be £2,400 for this particular burger van. So now comes the depressing task of adding all these costs together. And to do that, we're going to have to add up the total variable costs for that particular time period, which in our case, in our burger van is a month, and add that to our fixed cost for the same time period. So if you remember, we got £2,000 total variable costs, not just the £2 for one burger. And we've got to add that to the £2,400 for fixed costs. That's bringing us to £4,400 in total to operate that burger van for the month. Now comes a really important part. Hopefully, we've got money left over at the end of the month after we've paid out all these nasty costs with our revenue from selling our burgers. And in this case, happily, we do. Our revenue is £8,000. Our costs £4,400, giving us a profit of £3,600 per month. If the costs of operating that van were any more than £8,000 a month, then whatever that was, we would have made a loss for that month. So if costs are greater than revenue, the business will make a loss. So why is this significant? Why does a business need to make a profit? Well, a couple of really important points here. It allows a business to build up funds so it can afford to expand in the future. In other words, to do big things in the future. And that's the crucial point with profit, because profit accumulates over time. It's no use just using profit to pay workers' wages or paying for raw materials. Profit is bigger than that. It's a slow burn thing that businesses gradually accumulate, and they're probably going to want that to invest, to expand, to improve, to innovate in the future. In our case, Dave may have aspirations of moving into his own physical store so that he can have a sit-down menu and physically serve customers in a slightly more established way than just operating a van. It also means that the business can return some money to investors, probably not just in the case of a burger van, but slightly bigger, more established businesses may well get extra finance into the business by selling shares in that business to big investors called shareholders. And these shareholders are going to, in return for their investment, have a share of the business. And for that share of the business, they will be entitled to a share of the profits of the business. Now, the more money the business can return to them like this in dividends, the greater the incentive they will have to invest in the business in the future. And that could help it to expand onto bigger and better things. And that's a really important aspect of generating profit over time. So let's have a little recap then. How much of this did you remember from fixed or variable costs? Which of these costs are fixed and which are variable? So if you wanted to pause the video now, just test yourself, see if you can get them right. So, running through the answers then. You might remember that raw materials and bought-in supplies would be variable. The more products we sell, the more units of output we sell, the more of these things we're going to need to buy in order to do that. But this isn't the case with rent or insurance or salaries. That would stay fixed even if the business were to sell more output. Hourly wages, though, if the business wants to sell more, it's likely to have to employ more people in that customer-facing role or in production of goods and services. So these hourly wages are likely to be variable. They're going to increase when the business is busy and selling more units of output. Utility bills tend to be a fixed cost, though, usually. Packaging ingredients would be variable. And advertising, this is the one to really be careful about. This is fixed because if the business sells more units of output, it doesn't need to advertise more. In fact, that could actually operate in reverse, couldn't it? If the business raised its sales, it may even be able to advertise less. So advertise doesn't change directly with sales. It's not driven by sales. In fact, it could be the other way around. So we put that as a fixed cost. By now, you should be okay with these key terms and definitions. You should be able to remember what the formula is, or if it's a definition, be able to recall that. And going forwards, and this could be the topic of our next video, we're going to answer a 6-mark question on profit. Dave has run a burger van for 3 years now and has £20,000 of outstanding finance to repay on his startup loan. He's got an aim of being financially independent, that's his financial aim, and a non-financial aim of providing a service to the community because he's a nice guy. So we should be able to analyse the importance of profit to Dave and his burger van. So in the next video, I will help you to build up an answer to this that hopefully in an exam scenario will get you all 6 marks, and hopefully you can join me for that. But for now, thanks for watching.